Okay, by the way, this same company that we're willing to buy their stock because we know that over time they must grow, they're also a company that I wouldn't mind lending money to, in other words, buying their bonds. They're also a company that I wouldn't mind owning the real estate they occupy and leasing it to them, because I know I'm going to get my money back. Okay, so this is not a class to sell you anything, but if you wanted to know how we could buy their real estate, call me later. But right now, I've been getting a lot of questions from people saying, what you show us what to do on the stock side, what do we do on the bond side? We do the same thing. We look for that good quality company. We're not so concerned about paying too much for the stock because we're not buying the stock, right? But we are still concerned about them being large, prominent, conservative finance with good credit and solid earnings. So we don't care if the market's overvalued them on their stock, but as long as it's a good company, we know we're going to get our money back. Okay, so let's look at it. Let's go ahead and buy a bond, and I'll go through this scenario about what we do to buy a bond. I'm gonna go to Vanguard. Okay, I'm going to go to the personal investor site. I'm going to go research funds and stocks. And I want to hit stocks, bonds, and CDs. Okay, and I'm going to click on bonds and CDs. I'm going to look at bond yields. And I want to see them in a table. Okay, so if I'm going to buy a 10-year bond, let's say, I could buy a treasury that's yielding 1.98, which I'm not too crazy about. I could buy a strip, which doesn't pay me any yield. I buy it at a discount and it matures at face value, which would yield 2.2%. I could buy a government agency, Freddie Mac, 2.4. That's a little better. If I was just going to stay in govies, that's what I'd buy. I could get a muni, 10-year AAA is 181. Single A, I'm starting to look at credit problems at 372. I'm not sure if I would do that. But I look at my corporates, and a 10-year AA corporate's at 421. In this kind of interest rate environment, that's not too bad. So how do I pick a 10-year AA corporate? Well, let me go back and look at their inventory. Okay, here, see where it says buy individual bonds? I'm going to buy individual bonds. I want corporates. See what's out there. Let's just look from 9 to 11 years. And I saw what the yield range is, so let's say I should be somewhere between 4 and 6%. So there's, I guess, 77 bonds, and here's a list of them. Now, what am I looking for? I'm looking to lend money to a company that's large, prominent, conservatively financed with good credit and solid earnings. So let's take a look at that Best Buy. Here's a Best Buy 10-year bond with a coupon of 5.5% that I could buy at a discount. So it'll yield me 6%. What that means is if I put $100,000 in, I'm going to get $5,500 every year. It's only going to cost me $96,000. At maturity, I'm going to get $100,000. Okay, so which is going to give me a yield of 6%, which is not bad. My question is, are they credit worthy? So I'm going to look at them the same way I'm going to look at my stocks. I'm going to go to MSN. I'm going to look at the stock. I'm going to look at their financials, really. And let's look at their 10-year summary. Okay, they make money every year, right? And notice how this is out of order a little bit, but it's generally growing. Here's 11, here's 10, where's 9? 9, 8. So their earnings are solid. They're generally growing. They're paying down their debt. You see the most current year is the lowest one. Their assets minus their liabilities less than their debt. So they look like a pretty good company. Now the big question that Graham says to look at is coverage. They have coverage of 24 times. That means that their earnings cover their debt payment, which is what I'm concerned about, is that debt payment, by 24 times. He says if that number is at least 5, 6, 7, you're safe. You're safe. And it's consistently been high. It's not just that this year it was high. Over the last 10 years, they've consistently have a nice coverage ratio. I'd buy that bond. I'd buy that bond. Let's look at another one in the inventory. Okay, Morgan Stanley. Is Morgan Stanley still a standalone corporation? I don't remember. Would I buy that Morgan Stanley? I don't remember the symbol. MS. Morgan Stanley. Okay, here's a company that lost money for 2 years. I'm already not liking them. And they've been issuing a lot more debt, right? They're not paying down their debt, they're adding to it. I mean, they've been issuing a lot more stock. I look at their key ratios. 10-year summary. I'm looking for coverage. I wouldn't touch that bond. I could go through the list, each one, we're going to go through the same numbers. So I go back to Vanguard, and that's how you do it, you know. I'd buy that Best Buy with the 6.5. I wouldn't buy that Morgan Stanley.
Can I ask a question?
Mm-hmm.
What's the risk on the Best Buy bond? Could it fluctuate, the bond price?
Mm-hmm. Mm-hmm. You're buying it at a discount, so you're not doing. As long as you hold it, you're going to get 100. As long as they don't default, and you're going to get your 5,500. But yeah, from day to day, it's going to fluctuate. I'm not trying to trade that bond. That's not what I'm trying to do with the bond side of my portfolio. I'm just trying to get a nice 6% yield, which I don't.
The worst case is you keep it for 10 years, you're still going to get your 6% whatever, but it's not going to affect your principal price. You're going to get that $200,000.
Right. I don't need to really look at it really closely.
Unless you have a cycle.
Right.
Well, but if interest rates go up, the value of that bond is going to decrease, right? So there is some risk to the purchase price.
Not if you hold it to maturity.
Okay.
If I'm trying to trade it, I'm worried about that. I'm really not trying to do that with that side of my portfolio. My question is, do I have safety of principal? I think I've answered that yes. Will I get an adequate return? If I'm okay with 6%, I'm going to buy that bond.
But if you're going to float back and forth between your 25 and 75%, it's likely that you're going to need to make a shift one direction or the other within a 10-year time frame.
Yeah, so I'd probably stagger them. I wouldn't have them all come in due in 2021.
Okay.
So I've been building that out over time.
And when you buy a bond, I've never bought one before. I mean, what dollar amount are you having to put out on that bond? I mean, I think you said it was $100,000.
I think the minimum size on this is 2,000.
Okay, all right. So you can buy in smaller increments.
Mm-hmm.
Okay.
Yeah. So, and then as far as diversification, probably, 10 bonds. You're pretty well diversified.
6% is pretty much guaranteed.
Yeah. Yeah, I mean, that's pretty solid. They have a stronger balance sheet than the Fed. Although the Fed's, they've made a lot of money on this TARP thing, but we won't talk about.
45, what does that mean?
That's the most you could buy.
45?
That's all that's out there. 45,000,
Each bond is
$1,000. So if you bought 45 bonds, you'd probably spend 43,000, something like that, because you're buying them at 96 cents on the dollar, basically.
Does return come every quarter? Or?
You could look at them. Usually corporate bonds pay quarterly. Otherwise, they would say, because some of them will say on their monthly pay, because that's kind of a selling point. Otherwise, they'd pay quarterly. So that's how I pick a bond. I don't want to spend too much time on that, but I know I've had a lot of questions on it.
You mean that's the
Level 3 just issued notes last week at 8.5, which they're in our portfolio. I'd probably buy some of those too.
Is that just because of their maturity date or,
What's that?
well, that's not the outstanding available bonds for Best Buy overall, or is it just,
Well, yeah, a lot of people are holding them.
it's just for the 10 years?
Uh-huh. Yeah, so you could look at different maturities. I just searched for 9 to 11 years, 4 to 6%. You could play around with that.
So you could, in other words, there's, presumption is that Best Buy issues bonds as needed, but they would do it like every year, every other year, every third year, fifth year. So if you looked in on different, on different maturity years,
There's probably more out there, yeah.
more out there.
And this is just Vanguard's inventory. Bonds are a little bit different than stocks. Stocks trade in the stock market, and there's a lot more.
These are the bonds.
That's what Vanguard has in their inventory.
Oh, okay, that's available to Vanguard.
If you call them up, you say, hey, I really like these, I want some more, they could probably go out in the street and get them.
Okay, so if you bought through Vanguard, they have.
All they got is 45,000 apiece right now.
Is that how they're always sold in $15,000 lots?
Yeah, see, like this Alcoa, it has a minimum of 100. You got to step in with 100,000. The most you could buy is 129.
I see.
And when 10 years come along, you need to let them know that you want to sell?
No,
Automatically
they'll
get
drop the money into your account.
automatic.
There's not an option. Yeah, you'll get your 100.
So when buying bonds, you really don't worry about some of the other factors like the current ratio. If the current ratio on a company is say 1.2 or 1.3, but yet it's still got a good interest coverage, like 12, 20, something like that. Really, the current ratio is not so critical. It's only critical for the current flow of operations. Whereas in terms of paying bonds, which is almost a bankruptcy issue, then we'll still get our money.
Yeah. Okay. I don't want to spend too much time on that because we've got a lot of stocks to look at today. But I hope that kind of gets it started on how we look at bonds and how come I think I'm pretty safe holding Best Buy and not Morgan Stanley, and why I'm comfortable not buying government bonds. Why would I pay 2% when I could get 6 on something that I'm really comfortable with? Is it FDIC insured? No. Is it backed by the government? No. But it's backed by a company that has solid earnings and good coverage.